While we know that equity can be received from venture capitalists, debt can come from individuals and institutions, and typically from banks. Now, this is an area that unfortunately is not as popular as it probably should be when it comes to the entrepreneur ecosystem, and everyone is deeply focused on venture capital. But I do want to spend some time thinking about banks. Now, I'm not advocating one type of capital over another, but I do know that we are lacking some insight into what does it mean to get a bank loan, because obviously venture capital and equity investment is awesome if first and foremost you're building a growth or scalable business. Second, if you're interested in giving up a part of the company and sharing the risk as well as the upside. And third, that you actually have the financials to demonstrate that you need massive infusions of capital to be able to grow the business. And all of those are good things, and there's tons of people that are doing it. However, unfortunately, sometimes I see entrepreneurs who really have a cash flow issue, who are making money but have cyclical challenges that they find gaps in their cash flow statements. And they go after venture capital and take on massive amounts of money and give up the company when they really don't need to. And so I really want to think about the role of debt. Short term investment that has to be paid back with a cost, but certainly allows you to keep your company, is certainly much more practicable if you're running a lifestyle business, and probably possibly preferred if you're running a growth business, or as we saw in the funding path, something that may be considered even with the intake of venture capital. There may be a point of time you need a line of credit or some working capital, and that's better served through a loan than it is through providing equity and giving up a stake of the company. So let's talk about banks. Banks look at three things. They look at you and who you are and your ability to manage and effectively run a company. And some of that is track record, some of that is character, and some of that is your management of data that shows how well the company's doing. The second thing is financial. They want to know, can you afford to pay them back? And how quickly are you turning over money? And how much money are you taking in? And then they want to understand, what's the loan for? And is it going to be used for a purpose that they can pretty much say, you're going to be able to repay me? And those things are all important. It's important because when you walk into a bank, pretty much like when you're talking to a venture capitalist, it's a black box process. You don't really know what happens before you show up, and you sure as heck don't know after you leave. So let's talk about what goes through the minds of bankers as investors. So what they worry about is frequent excesses, not enough cash flow, too much inventory, too much accounts receivable, frequently going after money because you have a shortfall, because you've spent too much in the wrong department. They certainly don't want hardcore borrowing, which is borrowing really expensive capital from places that clearly do not have your best interest in heart. They want you to be responsive. They don't want you to just call them every week after they've left you several messages. They want to know that you have some service level response within 24 hours. And not just because they want to know where's their money, but they also can be helpful. It's important that we all shift our orientation, that investors provide capital, but they also can provide great advice. Now, you may not want it, but people give money with the idea that they want to help you, and that help can also come in non-financial ways. They worry if you haven't been able to meet your forecast, and they certainly worry if they see continued losses quarter by quarter and certainly year by year. But these are all things that luckily you can manage, and you can manage far enough in advance if you're paying attention to your financial statements. And while you're asking your questions, when you go to investors, you should know what the heck we're thinking. We're thinking about, what is the product or service and does it really solve the problem? We're thinking about, who are your customers and how fast is it growing? And not again because we want this big number in the bullseye, but we want to know, is the market big enough? And more importantly, do you have the ability to capture a significant part of that market to make sure that you're always going to be generating profit and building a scalable company? They want to know what your track record has been to date in terms of getting customers, and how fast are you getting new customers. They want to know your unit economics. What does it cost to produce your product? What does it cost to deliver your service? And is there scale? And remember, scale is not getting bigger. Scale is the ability to generate more outputs with the use of less inputs. Scale is the ability to generate more profit at a lower cost or lower set of expenses. That's what scale is. And so understanding your unit economics becomes extremely important. Now, what is your exit strategy? Now, of course, back in the day, everybody used to say, I'm going public. But there's lots of ways to have an exit, and we've covered some of them. You can get bought, you can be acquired, you can merge, you can buy your shareholders back in a shareholder buyback. You could accrue enough cash in the business that you buy those shares back. But the bottom line is an exit strategy doesn't necessarily mean something really big happens with the company. An exit strategy is, how am I getting my money back? Am I waiting for some significant tipping point in the market? Am I waiting for you to get international traction? Am I waiting for you to get to over 1,000 retail stores? I don't just want to know what the activity is. I want to know what's the strategy to get me my money back. Certainly want to know your burn rate, which is what is your monthly spend? How fast are you churning through money and at what rate? Is somebody else invested? Even if it's a small amount, it's important. Even if it's yourself, because you've clearly invested. Who has invested? Because that shows validation, particularly if it's someone other than yourself. Because ideally, if they're an investor or someone that has respect, they've demonstrated that they trust you, and that helps. Trust breeds trust. Who are key partners and channels for you to get your product or service to market? And part of that is not just knowing who they are, but understanding how they operate. Are they going to be around for a while? What are their margins? Are they going to change? Is it a disruptive business? Is it already established? All of those things create risks and vulnerabilities as well as opportunities for the business, but you better really understand how they operate. And then ultimately, what is the cost to build the business? And you should know that by your ability to look at your financial statements and continue to create projections on a go-forward basis to understand what is the infusion of capital to generate the kind of growth that you hope to see in the company. Now, it's important to have these statements because you want to be able to answer these questions. But I, as the investor, want to see the statements. If I'm a lender or a banker, or if I'm an investor and I'm a venture capitalist or an angel, I want to see your statements. And I don't want them as PDF. I want them as Excel because I want to understand your assumptions. Again, it's not about whether you're right or wrong because we don't know what the market's going to bring. But do I agree and trust your assumptions and how you have predicted the market? And have you demonstrated leadership and capacity to grow this business based on past accounting and what is seen in those statements? So it's important that you're able to, if you've been around long enough, to provide at least 3 years of audited financial statements. And audit is important because we always want to know that somebody else who is a little less biased than you has looked at these statements. We want to see any current statements that you may have on a quarterly or monthly basis. We want to know if there's any notes to your financial statements, if there's been any adjustments or course corrections that have needed to be made. Again, not bad, not good, just data that helps inform, can I look at these statements and generate a level of confidence that says you're going to perform as expected? Does your balance sheet balance, which is always important? Have you included all the types of statements? And do I know and do I have your income statement, balance sheet, and cash flow statement for all the time periods that I've requested? Because remember, we talked about how they all are interdependent. I want them all. The numbers are a depiction of the decisions you've made and can I see any trends? The numbers are a reflection of how sales have gone, which implicitly means how well you've been able to attract and retain customers. Do I see any trends? And certainly something that's really common in the banking world is something called CAMEL. That is capital, asset quality, management, earnings, and liquidity. And we're going to go through each of those, but you may hear behind the scenes, or if you know a banker, that they do a CAMEL analysis. And so they want to look at the capital structure. Are you looking for debt or equity? They want to look at your assets and how valuable they are. Are they appreciating or depreciating? They want to understand what's the debt you're trying to get, what's the term, how long, what's the rate, how much, and then do I have a level of seniority that if you have another loan or a couple of other loans and something happens, do I get paid first? Do I get paid in the middle? Or do I get paid last? I also want to know if I'm going to ask for collateral, whether it's your personal collateral, your house, your bank account, or is it the business, or is this going to be an unsecured loan? These are some of the things that bankers decide when they decide to offer you a loan. They're going to want to know, are you diversified revenue sources and how confident am I in the sources of capital revenue that you've predicted? I also am going to look at your accounting statements, which reflect what you've done so far. I'm going to look at what other investments you've made, and I'm going to talk to you about what are your plans and contingencies, but also, are there any other liabilities out there, accounts payable, things that you've deferred, including salaries that I'm going to need to know about, because all of those things are going to have an impact on my ability to get my money back, because somebody else may have greater seniority than me. I want to look at asset quality. Are they stable assets? Are they depreciating? Are they already pledged against somebody else? That's really important. And then management, spending time with you, spending time with your team, understanding your board. And understanding your board is really not about not trusting you, which I think sometimes entrepreneurs and CEOs feel like the board is bigger than me. Well, in some ways, they're not necessarily bigger than you, but they're certainly sharing the risk with you because they have something called fiduciary duty, which means they are legally liable for the sustainability of the business, and they're legally liable for any reporting on finances or accounting, and that they know it to be true. And so that level of validation and support, not critique, but validation and support is extremely important. And so they want to know there's active governance in the business. We want to know earnings, and this is obviously all reflected in your financial statements. We want to know that there's a track record. We want to understand what's behind those earnings. How are earnings generated? How stable are they? How many more customers do you need to meet your projected earnings? And so that's really important. We also want to implicitly understand margins, that for every dollar you make, how much is it costing you? Because if there's a certain set of customers that right now it's costing you $2 for every dollar you make, that may not be a bad thing. But you need those customers to get the other customers where you're going to make more money. You need to break into a certain segment, and sometimes you do that at a loss. But that means for longer potential upside because you've proven yourself, and now you can attract customers quickly. And then obviously liquidity becomes extremely critical, because liquidity is my ability to convert to cash. And so I want to know that if something goes awry and you have a quarterly loan payment due, can you still pay it? Are there enough retained earnings to be able to make your loan payments for a year, or make your loan payments at least for 3 to 6 months? And what are your policies around maintaining cash, or versus when you turn cash into an investment and then it gets locked up and then you can't pay your expenses? And so just again, how you're managing the flow of money, that's important for an investor, particularly a banker, to really understand. Then we want to know, is somebody going to take this loan? Is it a personal loan? Is it a company loan? Is a board member willing to co-sign for you? Because depending on your financials and obviously credit scores, you may need somebody else to co-sign with you. And then all of that allows me to come back to you with an offer of the length of the loan, the type of the loan, secured or unsecured, how much it's going to cost, and any other requirements I have or covenants. For example, it may be that you've been a little lax on your quarterly reporting, and I say, look, your annuals look great, but I need you to report to us quarterly. Or it may be that you have a certain type of accountant and they want you to get a CFO, or they want you to add a financial person to the board of directors, or they want you to share any new accounts that come in at a certain amount, or they want you to share when you lose a big account. And all those are realistic expectations. It's not because they don't trust you. In fact, those kind of requests build confidence. And that's extremely important that you take on that perspective. The final thing is that in addition to all of that CAMEL, which again is typically done in a lending world, there are a set of business ratios that all types of investors run, because once again, they depict your financial health. Now, these are ratios that I share with you not to scare you, because I realize you may be a little panicked after you see all those things that bankers are going to request and all that analysis that bankers are going to do. But these are ratios that oftentimes investors use and entrepreneurs don't, and I highly encourage all entrepreneurs to use, because once again, they're easily calculated from your financial statements, and they depict the financial health and help you make good decisions for your business. So the first set of ratios are the type of profitability ratios, and they speak to how you make money. Gross profit margin, operating profit margin, all things that you should be familiar with, that you may be getting calculated by the touch of a button, but you want to know how to do it yourself, because this is something you don't just want to do on your current position, but you want to begin to see how your margins will change based on future projections. There's your liquidity ratios, because it shows how quickly do you have access to cash to be able to pay off any expenses or liabilities. And then there's leverage ratios. What do you have within the company to help you leverage or get other financial or non-financial assets to help grow the business? And then if you happen to be in a product business, activity ratios in terms of turnover and how well and how effectively your inventory is working for you, whether it's books, t-shirts, hair care product, beauty product, whatever it is. This is important so that you're not wasting money by sitting on inventory that's going to go unused or actually has the risk of expiring. So what you can see is that this opportunity of really starting from little things of just how you keep receipts, and certainly having a personal account and a business account, and being able to see how well your business is doing by just adding up all your revenue and taking out all of your expenses, that is the underlying process that continues. So don't get scared by the numbers. But it's important that those activities that help you plan how to spend money are only magnified and amplified in financial statements. And those financial statements should be considered tools, not scary items that you use and lenders use and investors use and suppliers use to be in a relationship with you, to mitigate risk, to use those to determine how can I work with you. And your ability to stay on top of them and to have the discipline to do them on a monthly, quarterly, and annual basis are extremely important, because as you see, you come full circle. If you're a lifestyle business, you want to be able to know those expenses to make sure that you still can have a lifestyle. If you're a growth business, you want to make sure that you can accurately depict the financial health of your business by looking at your statements so that you can actually see and prove that you're growing. And certainly the same for a scalable. And in both of those scenarios, if and when you need an infusion of capital, whether from a vendor or an investor or anything in between, the financial statements will be invaluable and critical in depicting the financial health of your business. And that is something you have full control over. So I hope that you've not been scared by these accounting and financial essentials, but hopefully feel empowered, because there are tons of systems and other people that can do it for you. But at the end of the day, this is your business, and you need to be able to own and account for every asset and liability and be able to sleep at night and know that you are building not just a financially healthy business, but a financially sustainable business. Good luck, and I hope you enjoy numbers just a little bit more after you've heard this presentation.